Thanks everyone for spending your Sunday afternoon here with us, the moomoo team. Right, very happy to be with you guys. Now, before I dive into my presentation for today, right, which will be, let me just go to the next slide. Okay, yeah. So today I'll be sharing with you guys a market outlook from a very technical perspective. And there's a reason why I'm actually sharing this from a technical perspective. Okay, the reason is because, you guys are here today, you took time out of your busy schedule to actually learn about options. And when it comes to trading options, when it comes to investing using options, right, technicals is something that is actually required. So before we go through the rest of the program for the day, I really want to get you guys looking at the US markets from a very technical perspective, from a technical lens. So before we start, I just want to have a show of hands, right? Just to get a few of the experience across the room. How many of you have been trading for the past 3 years? Just a show of hands. Okay, a few. How about the past more than 3 years, 5 years? Say for example, 5 years. Okay, a bit more. 8 years? Just a few handful. 10 years? Okay, all right. Okay, so I will try to tailor towards that, all right? So no worries, let's try to keep it easy to understand, easy to digest for all of you. So I hope you guys will be able to see the slides. Let's move on. All right, so very quickly, I'll share with you guys the overview of the US markets, right? Why we are looking at some of the indices. Why do we look at some of the different asset classes that we look at? And why is it important to form a holistic picture of how the US markets will perform in the next couple of weeks, going towards the end of the year, and maybe the first 2 weeks of 2026. And then I'll move over to top-down approach, right? Give you guys a broad view, okay? And then we'll go into peer group review, and then after that, the conclusion for this session. All right, so when we first talk about the US markets, we always want to come in from a big picture view, right? Whenever we do our analysis, okay, how many of you here dive straight into the individual stocks that you want to look at? All right, how many of you do it the other way? You guys do a top-down approach, right? You start off with the broad economy first. Okay, only a few handful. All right, so our purpose here today is really to help you guys form a systematic framework, whether it's trading options, whether it's investing through stocks, right, or any other asset class, right? It's very important whether you are a short-term trader or long-term investor. It is very, very important to actually have a systematic framework. Right, so first and foremost, okay, we look at the US equity indices. We look at the S&P index, that's the SPX. We look at the NASDAQ 100 index, right? And then we look at RSP. So RSP is actually the equal weight S&P index. Increasingly, it is actually quite important to look at the RSP, right? The RSP is actually a S&P equal weight index that can be found on your moomoo app. And what is the difference between the RSP and the S&P is basically over the past couple of years, you have heard or you have read, I'm sure you guys have read in the media, that S&P is increasingly weighted towards the Magnificent Seven, right? So when this Magnificent Seven stocks move, okay, it actually leads to quite a measured move in the S&P index as well. But we do not know how the remaining 493 stocks in the S&P 500s are actually moving, right? So that is why we have to take a look at the equal weight, where this index, this RSP index, actually gives an equal weightage to every single 500 stocks in the S&P. So you get a better idea of how the other sectors are performing relative to the Magnificent Seven. All right, then of course there's RTY, which is Russell 2000. That is the small cap, the small mid cap of the US markets. We also look at the VIX index. Today, if you guys are going to be looking at options, right, VIX will also be something to take into consideration. Volatility. There's the US dollar index. It is very important as well, seeing that the US dollar is the world's reserve currency, right? And even the US Federal Reserve the FOMC interest rate decision also sort of, to a certain extent, dictate the strength of the US dollar, which by extension also then impacts the US treasuries, which is your 2-year bonds, right, or your 10-year bonds, and then longer dated, the long end will be, say, maybe the 20, the 30-year, right? But I'm not going to go into every single one of it. So it is over here which I want to ask you guys, when you guys take a look at the US markets, how many of you still look at the Dow Jones Industrial Average? How many? Okay, might see two hands up. So increasingly, people do not look at the Dow Jones Industrial Average. The reason is because it consists mostly of price-weighted average of 30 blue chip stocks. The US market is so huge, right? And the Dow Jones only consists of 30 of the biggest blue chip stocks. And even then, it's price-weighted. It is not market capitalized, which means that if a stock price, if A has a price of $100, for example, it is actually considered more important in the Dow Jones Industrial Average compared to stock price B, which is maybe only $20. But having said that, stock price, company B could very well be a huge market cap, right? Maybe they have done a stock split, that kind of thing, right? And then because of the price-weighted way of measuring the Dow Jones Industrial Average, the stock company B then becomes less important. Also, a lot of ETFs out there, a lot of products out there are actually built on S&P 500. They are not really built on the Dow Jones Industrial Average. So by setting this up, we can then move into, okay, the technical picture, the technical aspects of it, right? So this is where I think you guys will want to take out your phones and take pictures of the chart, because I'll be sharing with you guys the short-term outlook. And as always, we start with the big picture view. So this is the first chart, which is actually the S&P, right? It is the S&P, it is the daily chart. I want you guys, while you are taking picture of the chart, I also want you guys to pay attention to the configuration of how price is moving, okay? So basically, on the left-hand side, going into the middle, right? S&P is trending higher, okay? And then suddenly, there is a chop, right? It drops lower, and then after that, there's a rebound, which is where we're at today. So you realize that where the current price is right now, so the start of the blue arrow, you realize that where the current price is right now, there's still quite a bit of distance to the top. All right, so that means the way I look at it, I still believe that there's still some upside, but the upside is very limited, which is why I prefer to take a cautious stance on the S&P. Now from the S&P, we move over to the RSP. Right, again, you can see that the configuration is quite similar, but this time round, the moves are not as pronounced as the S&P. Right, as I shared with you guys just a couple of minutes ago, the RSP is actually the equal weight index of the S&P, which is why you can see that the movements are not as pronounced as the Magnificent Seven, where there's so much volatility and all that kind of thing. Thank you very much for dimming the lights. Now, but at the end of the day, you can also see that the way the RSP is configured, the microstructure of the RSP is configured, it is actually already making a new high, right? Whereas the S&P has not yet made a new high. So what does this tell you guys? It actually tells you guys that if you were to look at the broader S&P, you look at the broader US market, okay, the rest of the other 10 sectors other than tech is actually relatively healthy. It is actually performing relatively well as well. All right, so all that fear, all that scary talk about, oh, the market is selling off, recession is coming, right, doomsday is approaching, there's a bubble, right? I think that was all the hype generated by the media. Now we move on. Very quickly, this is the NASDAQ. And you can see that the NASDAQ is actually very similar as well. Now, all these are US focus indices, right, index. So that's why all their configuration will be more or less the same, especially the S&P and the NASDAQ. Now, when I was preparing my presentation, I really struggled whether I should put the NASDAQ in, because firstly, I'm going to waste time talking about it. Secondly, I'm not sure how much of a value add it will be. But upon careful consideration, I added it in because looking at where the NASDAQ is compared to where the RSP is just now, the RSP already shaped a new high, right? Or at least testing the historical high. NASDAQ is only halfway there. Okay? There's still a bit more room to the upside. All right, so even though, yes, we have seen a bit of tech weakness in the past 2 to 3 weeks, right? There's still quite a bit more upside on the NASDAQ. All right, and from then the NASDAQ, we move on to the VIX. Okay, I believe I'm supposed to go back. There was supposed to be one more chart behind. Yeah, the RTY. Okay, the RTY is the Russell 2000. So that's the small mid cap of the US markets. Okay, over here you can see that the RTY is a bit like the RSP. Right? The RSP is already at historical highs or already breaching the historical high. The Russell 2000 is coming very close to its historical high, which then you can see that from a price action perspective, from a technical perspective, right, the small mid-cap stocks of the US market, those 2,000 smaller stocks, their bullish run might be a bit exhausted at this point in time. It could very well be coming into a resistance, right? So relatively toppish. And with that, we move over to the VIX. Okay, and we can see that, so for those of you who actually attended my webinar just this past Tuesday, this VIX was there as well. There wasn't really much update. I just drew the levels for you guys. Right, we can see that after all the spikes above the arbitrary 26 level, okay, it looks like the VIX volatility is coming down towards the support. Okay, so putting all these things together, right, just putting the indices together and putting the VIX together, right, we are coming into lower volatility, maybe because it's the holiday season, right? Secondly, we are seeing that across all the stock indices, right, the one that seems to have very limited room for run is the Russell 2000, which I personally don't think a lot of you guys will be trading, right? But if you look at the NASDAQ compared to the equal weight index, right, NASDAQ still has a bit more upside. The NASDAQ future still has a bit more upside. The equal weight index already is breaching the all-time historical high, so you might want to buy into from a trading and investing perspective, right? Sharing with you guys my thought process. You might want to allocate some of your money into this equal weight because there's going to be a breakout or it has already broken out, right? You don't want to miss out the broad market move, but at the same time, you know that there's still quite a bit of upside potential on a tech-focused index. Okay, then we move on to the dollar index, the US dollar index. And some of you will ask me, why is this important, right? There's always that talk about US dollar losing its reserve currency status. Again, I want to make it clear that the US dollar is not going to lose its reserve currency status anytime soon, okay? It is pretty much impossible, all right? The reason because it's still very much used in trade flows, in businesses across the globe. Just 2 months or 1.5 months ago, there was a central bank survey, global central bank survey that was actually released. US dollar is still used in at least 89% of global trade. The second currency, which I believe was the pound, if I'm not wrong, I cannot remember clearly, the pound, right, came in at about 38, if I'm not wrong, all right? So you can actually Google the numbers, you can go and check, right? But what I'm trying to say here is that the use case of US dollar is still at number 1, and the second place is so far away, right? So it's impossible for the US dollar to be taken off as the reserve currency. But either way, if you look at it, right, the US dollar has weakened recently, and at the end of the, it is still holding on a near-term uptrend. I still see a short-term bounce. And when there's a US dollar bounce, right, generally you'll see a bit more chop in the S&P index. The reason for that is because the US dollar, the characteristic of the US dollar tends to swing from a safe haven currency, right, to one that is a bit more risk on, okay? It's not always a safe haven currency. So with that, I'm just going to put everything together, okay? Now that you have done the top-down approach, okay? You have done the top-down approach, you have looked across the board of US markets, right? You can see clearly that S&P 500, equal weight S&P, NASDAQ, Russell 2000s, right? They are generally neutral. You expect a bit of chop. They are quite toppish, especially for the Russell 2000s, right? The best index with the best upside, the biggest upside will actually be the NASDAQ. Okay, so over here, if you want to construct a portfolio, you want to diversify your holdings, right? Then focusing on the RSP will actually help as well. And you don't have to worry so much about going into the end of the year, right? There will be volatility, but for now, as it stands, volatility is relatively low. Okay, and the US dollar is expected to still strengthen ahead. This thing is not very sensitive. Okay, so with that, okay, now that you have formed a holistic picture of the US broad outlook, right? What we want to do is to actually drill down. Okay, we want to drill down to a peer group review. You want to do a relative valuation. I like to use this example. If I were to come up to you guys and say that, okay, hey, I scored 100 out of 100, does it, in a class test, does it really mean that I'm smart? Right? On the surface, it may mean I'm smart, but if I were to tell you that the rest of my class also scored 100 out of 100, then maybe it's not the case that I'm really smart, but rather the lecturer set too easy a paper. Or maybe all of us were just cheating, right? Okay, but we take a look at the peer group review, and I just want to guide you guys through, now that you know how the US markets are going to look like going into the end of the year, the first 2 weeks of 2026, how can we position ourselves more from a short-term trading, swing trading, or position trading perspective. So over here, this chart, right, is the SOX index. How many of you are familiar with the SOX index? SOX index. Okay, a few hands. Okay, so for those of you guys who do not know what the SOX index is about, over the past few years, the SOX index has actually gained quite a bit of popularity. It is relatively somewhat similar to the XLK ETF, which is the tech sector. The only difference between the SOX index and the tech sector ETF, the XLK index, is that the SOX index actually takes into account more semiconductor names, right? So it gives you a broader view across the board of all the tech and semicon names. All right, so over here, I just want to take a look first and foremost at the SOX index, and you can see that this configuration looks like, anybody want to shout the answer? Anybody want to try? Ask you guys to pay attention to the structure of the markets just now. S&P, yes, very good. It looks like the S&P, and because it looks like the S&P means it's also skewed to the Mac 7, which then it also looks quite like the NASDAQ as well. So thank you very much. Your answer is correct. Unfortunately, I don't have any prize for you. Okay, but yes, so this is how it's like, right? We have actually already bounced off the bottom, and there still seems to be a bit more upside, okay, at least to the all-time historical high of the SOX index. So keep this in mind. But like the examination example that I gave you guys earlier, okay, you don't want to just look at the SOX index alone. There has to be a point of reference. You need to have a comparison. You need to be able to compare the SOX relative to something else. And this chart right here is the SOX index compared, okay, to the S&P futures. All right, I made it very easy for you. This is not something that you can trade. It is very, very simple mathematics, right? I do hope that one of these days we will be able to get this function on the moomoo charting app. Then you don't have to keep switching between all your different charting platforms. Okay, but what you want to do is you want to take the SOX index, the price of the SOX index, divided by the price of the S&P 500 futures. Then you will get this chart. So every single day, the closing price, you take the price of SOX, divide by S&P futures, bam, you get this chart. Okay, and how you read this chart is actually very simple, right? As long as the chart is trending higher, it's like your simple ratio, right? SOX divided by SPX, right? As long as the chart is trending higher, it means that the stocks index, semicon and tech, is outperforming the rest of the market. Okay? If the chart is going lower, if the ratio is going lower, it means that it's actually underperforming the S&P index. Okay, so when you look at this, right, over the midterm, the ratio is actually holding on an ascending trend line support, which then means that regardless of the volatility, regardless of the chop, regardless of the sell-off, right, on the midterm, we can still expect that tech and semicon stocks will still continue to outperform the S&P. All right, but outperform to where? Okay, this is where you use your technical analysis and then you put in your support resistance levels, and you can see that we still have quite a bit of upside, okay, to at least the recent swing high of this ratio. All right, so there's a bit more upside. After that, when it goes, why you always see the blue arrow, I have to say, is that even though I'm leaning in more towards the bullish directional bias, right, when price makes a second top, what chart pattern is that? You guys want to try? Again? I heard something. Double top, that's right, very good, okay? So, even though there's a recovery, I guarantee you, if you were to look through the media right now, there will be quite a number of headlines that says, is this a real recovery or is this a dead cat bounce? Right? Because from a chart configuration point of view, you actually still have this risk of a double top formation. But as where we stand now, okay, there's still a bit of limited upside that you want to capture. And this goes on for the rest of the day, where our options masterclass will tell you that if there is a risk, how can you actually use options to capture that limited upside while managing your risk exposure. Okay, so and then from there, now that you have the understanding that the stocks index is going to outperform the S&P, what you can then do on our moomoo app is to start looking for individual stocks that you can start filtering by fundamental factors. Okay, so it's not just all about technical. It's also important to consider the fundamental factors as well. Now, this is the NX platform that we use. I actually prefer the NX platform compared to just looking at my app because my eyesight's not very good. So when I put it up on my computer screen, it's just that much easier to see. Right, but whether it's on your app or on the NX platform, on the top left-hand corner, you can actually go to markets, and then you can just search, right? You can search the word stocks, so you can see point 1, go to markets. Number 2, click the magnifying glass, search for stocks. Oops, sorry, went too fast. Okay, and then after that, point 3, when you go to the stocks index, the first thing you see is a very beautiful chart, right? But there's this small word over there that says components. Okay, this is important because you don't just want to blindly trade the stocks index. And even then, even if you see a bit of risk, you can't really use options on an ETF, right? So you want to go and pick out individual stocks. And when you go to components, you see a very nice chart, nice picture after that. All right, do not feel overwhelmed. Right, but basically these components list out every single counter that is actually included in the stocks index. All right, but the way the app is formatted is that it will just show you the names according in alphabetical order. What I personally like to do is I would actually like to arrange it, okay, by market capitalization. All right, but of course you can actually use options factors, the Greeks, okay, to filter all these stocks as well. All right, so that is how we can actually, this me walking you guys through a top-down approach of the US market, right? Forming a holistic view of how the US market is expected to perform. And then when we have identified the opportunity, we can actually deep dive down into the individual indices, into the individual index, and even look at the components to start picking out what are some of the fundamentally more strong individual counters. So just to tie everything together, right, some concluding thoughts, okay? This is a chart that has actually been done by the good folks at Bloomberg Intelligence. It's been segregated into different colors. I want you to pay attention, especially to the orange line, and the blue line, not so much the red line, right? It's a 5-year period, okay? It's separated into 5-year period, 5-year period, 5-year period. And this is what we technical analysts call the secular bull run, right? It means that structurally, the market is just in a bullish environment, and the trend is actually pretty strong, right? So that is what we call secular bull run. Now, if you look at the orange line, which takes into account leading up into the dot-com bubble, is the 1995 to 2000, right? So that's the dot-com bubble period. And then you look at the post global financial crisis going into the COVID crisis, the blue color line, the teal blue line, you can see in the middle that there generally is a sell-off, quite a relatively strong sell-off, right? Around in between the 800 to 900 day mark, okay? There will always be a first sell-off, and then after that, it continues to trend higher because of a secular bull run, another sell-off, market meltdown, and then after that, the secular bull trend continues, right? So because of that, okay, the average, I mean, it's only a sample size of 2, so not very accurate, but for what it's worth, right, it falls between 800 to 900 days. Where we're at right now, the white color line, 2022 to present, is only 3 years, right? We are still behind the 800 days mark. Okay, so in terms of capturing this bull market, right, based on past data, there is still some further upside. So what I want to conclude with is, at the end of the day, I'm still cautiously bullish going into the end of the year, and even into the first 2 weeks of 2026. And this, ladies and gentlemen, is how you can actually follow my thought process and how you can actually build a systematic method, right, to approach a market analysis from top down, and then you compare it to peer group, you form your views, you come to your own conclusion, and then you decide how you want to invest. As for formulating a trading plan, stick with me. At the end of the day, I will share that with you guys as well. So thanks again for your time here, and I wish you guys a good learning journey for the rest of the day. Thank you very much.
Thank you, Isaac, for the wonderful insight for the indices.